people, welcome to episode 17. And in this episode of Credit 101, we're going to talk about the VantageScore. I know we talked about FICO before, but the VantageScore is kind of different. So I want us to know the difference between a FICO and a VantageScore, because a lot of people always say, well, Credit Karma says this and my FICO says this. So I want to talk to you guys about the Vantage, because Vantage is what Credit Karma uses. So VantageScore was first introduced in 2006, and they have three separate versions. They have the Vantage 2.0, Vantage 3.0, and then Vantage 4.0. So with the Vantage 2.0, their credit score is from a 501 to a 990. Okay, so the different companies can use different models. They can pick which one they want to use. Same thing with FICO. You have all the different FICOs. They can pick which FICO they want to use. Now with the Vantage 3.0 and 4.0, which is what Credit Karma uses, their credit score go from a 300 to an 850. Okay, now they have different levels. So they got A, B, C, D, and F's, just like a schooling model. Like, you know, we're in school, they have different grades. They have a different grading model for them. So if you want to get an A, and this is with the previous 2.0 too. So if you want to get an A, your credit score needs to be between a 900 and a 990. If you want to get a B, you have to have at least an 800 to an 889, also 899. Also a C will be a 700 to a 799, a D 600 to 699, and then a D is 500 to 599. So understand that if you guys are having a, you have an F, and then sometimes that D is still bad too, because don't forget, this one is going all the way up to 999 compared to the 850 that I told you guys about. So you really, for this one, you really want to be in that B range and C at the least. Okay, so if you guys were to see certain models, I forgot what Wallet Hub uses, but you got to think about it. All those little third-party companies, they use some sort of Vantage. So you have to figure out what numbers they're going based off, so you can know which Vantage they're using, which Vantage score that they're using. So I want you guys to understand, you want to, if they're going all the way to 990, you want to have at least a C, and a C is still, you just passed. Okay, that's what that means. Now you have to figure out what actually affects your Vantage score. So late payments greatly affects your credit score. Late payments is like the number one thing, you guys, when it comes down to your Vantage score. If you guys get these late payments, it's going to hurt you all a lot. So make sure you guys don't have any late payments. Make sure all of your accounts are set up on auto pay, and we're going to get into all these juicy details, because I remember going through the cycle of having to refix things because I just didn't know the basics of like setting things up on auto pay. Also, the age of your accounts, the type of account you have, in your utilization, you guys. Your utilization is how much you have available compared to how much you spent on your credit card. So how much your limit is. So make sure you guys keep your utilization down. I always tell people, don't spend more than 5% on their credit card, or at least don't let the credit bureaus know about it. Basically, when your due date is here, you pay it all but 5%. Okay, and that's going to keep you at the highest credit score possible. Also, something that mildly affected will be like your total balance compared to your debt. So that's going to mildly affect it. So they're going to look at all of your debt. I was just telling one of my clients, like, hey, if you want to get anything, try to get these things before you have a mortgage hit. Like if you want to get a car, try to get all these things before you have your mortgage hit, because your mortgage is going to drop your credit score most likely. And on top of that, you probably at your peak right now, okay, with your score. Because when that mortgage hits, you got to wait for your credit to readjust. And then plus you have more debt on your credit reports. So try to go ahead and get whatever you want to get before you get that mortgage. So your total debts is going to mildly affect it. Also, inquiries. Inquiries are going to drop your credit score a few points, but I always tell people inquiries, probably like 3 to 7 points per inquiry. It's going to affect it. So try to get these inquiries removed. If they're not yours, you can simply just call the credit bureau and say, hey, excuse me, I have this inquiry on my credit report and I need to get this removed because it's not mine. Like, you guys need to remove this today. And they should remove it. Sometimes you're going to get some type of pushback saying, no, we're not going to do this. You can't do that. You got to send a letter in. We need some type of report. All you have to do is hang up and call back. Okay. Seriously, that's some serious gems right there. Also, with the Vantage 4.0, it also considers the trends. So when you guys are using a lot on your credit but paying it off. They can see the trends on, you know what? Every month she been doing this, or every other month she do this, she'll pay it off, then the next month she'll max it out, or she'll keep a balance here, or for the last few years we've seen that this happened. That's trended data, and they're going to try to predict what your future is going to look like. So for the Vantage 4.0, they're going to say, okay, well, around this time, Rickita usually apply for credit cards. That's because she's going through this, or we'll know what she's going through, but this is usually what she do. So you might want to watch out, and it's going to drop your score because it's off trended data. Okay. Again, inquiries are only going to lower your credit score a few points. You really need to focus on those late payments because that's going to really hurt you. And also, this is your Vantage credit score. This is not your FICO. This is the Vantage. Okay. So understand that each one have certain things that they want to look at, but late payments and utilization is like the top one. Seriously, late payments and utilization. And this is episode 18. In this episode, we're going to talk about civil judgments, tax liens, and other debts on your credit reports. Now, when it comes down to judgments and tax liens, you guys have to understand that in 2017, the major credit bureaus started to remove these tax liens and civil judgments from our credit reports. And I say ours because you should not see these type of things on your credit reports. No one should. Okay. And then in 2018, they announced that they would remove all tax liens. So if you guys did have a tax lien in your credit report, it got removed, and it should not be any on there now. So a lot of people may be concerned, like, oh my gosh, the tax lien is going to be on my credit reports. Don't worry, it's not going to be on there. Okay. In 2018, they said they were not going to do it. And then the removal of debts that did not arise from a contract or agreement, those have to be removed also. So for those gym memberships, those library, any fines or fees you got, just ordinary fines, and then your traffic tickets, all of those different things were told to have to be removed from your credit report. So all three bureaus. So if you see these different things, you guys, you shouldn't at all. You need to call the credit bureaus right away and say, hey, you got this tax lien on my credit reports. You need to remove it. Okay. Now, bankruptcies is a whole nother thing. Bankruptcy can still be on your credit reports, but there's a way of possibly remove your bankruptcy if it's reported inaccurately or if it's not yours. And we're going to talk about that later on in Credit 101. Okay. And this is Credit 101, and this is episode 19. In this episode, we're going to talk about Experian Boost, and we're also going to talk about the Ultra FICO score. So I don't know if you guys heard about this. I tried the Experian Boost, and honestly, my credit score didn't go up that much. And that's probably because I already have things on my credit. Now, a lot of people that have a thin credit file, which is what this can really help for, they can use that Experian Boost, and hopefully it will increase their credit score, because that's all it is. It's adding trade lines onto your credit reports. And usually it may be, some utility bills and things like that, your phone bill, and they need to get access to your bank account, which we're going to talk about that. So with creating the Ultra FICO scores, it was designed to raise your credit score. That's all it is. They wanted to make sure they create something that will actually raise your credit score. Both of these is going to need access to your banking history. So you have to give them access to your banking account. And I know you have to give them complete access. That they're going to go through your statements. The computer is going to pull out what it needs to pull out, and then they're going to have all this information. But then they'll say, okay, we see that you made so many payments. You're always paying your utility bill on here. You always pay your phone bill. You have another thing, and they can add that as trade lines on your credit reports that could actually increase your credit score. Now, the FICO, the Ultra FICO, they're going to consider your checking account, your savings account, and then your money market account history. So they're going to go based off of your history in terms of your account. So even if you guys, I want you guys to understand this. Some people may be watching this like, this don't even apply to me. I'm not going to use it. A lot of times, even with credit, you guys, they were getting these things behind our back, and we didn't even know, they were taking a lot of stuff into consideration. A lot of people didn't even know about their credit reports before. A lot of people started learning more about their credit reports when Credit Karma and things like that came out, where they can actually see it and know exactly what's on there, what's being reported. So we have to take these things into consideration and look at them and know exactly what's going on. Now, Experian is, like I said, is they're going to look at your utility bills or like phone bills. That's what they're going to look at, because that's what they're going to want to put on your credit reports with Experian Boost. I think mine probably went up like 7 points. I guess it's something 4 to 7. I don't know, because I'm starting to think 4. Okay. But I just didn't think it was worth it. I gave them my banking history, and I didn't like that. And the reason why I'm telling you guys, like, be careful is because with Equifax, they had a breach in 2017 and they keep having breaches. And I don't know if you guys heard about what happened in Vegas where their whole system was shut down. Hackers got it. Like, what happens when all your information is with them? So take that into consideration. Like, what if they get hacked again? All your information is going to be there. They have your complete banking history. They have your account number, your route number. They have all this information. So you want to make sure that your information is safe. Like I said, mine went up 47 points, so you have to decide if that's going to be worth it for you. And this is Credit 101, and this is episode 20. In this episode, I want to talk to you guys about Fannie Mae. If you guys don't know, Fannie Mae and Fannie Mac, so we're going to talk about both of those. If you guys have any questions, definitely let me know down in the comments. Now, if you guys don't know, Fannie Mac, they're a large government controlled company that buys a large percentages of mortgages. Please excuse that typo with large, but they buy a lot of mortgages, you guys. So that's what they do. If you guys don't know, that's who a lot of, like, if you go get a mortgage, they're going to most likely sell it. Okay. So keep that in mind. Okay. So to sell your mortgage to Fannie Mac, they must meet certain guidelines. So Fannie Mac, they have certain guidelines that you guys have to make sure that you meet. So one of them is that they require that their lenders use a FICO score. So they have to use a classic FICO score to measure your credit. Now, each bureau have their own thing. So this is the one that Equifax uses. They use the Beacon. And then also Experian use their Fair Isaac risk model. And then also TransUnion, they use a FICO risk model. So each one, they have their own bureau that they're using. So they put requirements on there. Hey, for you to sell it to us, you have to make sure you pull this report. So keep that in mind, you guys. And also in 2022, as of then, it requires you to have at least a 620 credit score, okay? And that's for fixed rate mortgages, and then a 640 for adjustable rate mortgages. Now, how everything is going right now, when it comes down to interest rates and all the fixed rates, adjustable rates, make sure you guys talk to a mortgage lender. If you guys need any suggestions on that, definitely call me, 833 Rickita. I can help you with that. Find you a good lender that can help you get approved. But this, you guys, think of this as like a conventional loan. You need to have a 620 credit score, okay? And then lenders could ask you for more. This is just the basic requirements. If they meet all these different things, and they can sell it to them. So that's the basic requirements. Let's go ahead and talk about FHA, because when it comes down to mortgages, we need to know about the score. That's what we care about. We don't really get into the real estate portion of it. We want to talk about the credit. The biggest thing is for you guys, they're going to pull your FICO score. You need to make sure you have a 620. This is Credit 101, and this is episode 21. In this episode, we're going to talk about the Federal Housing Administration, but it's also known as FHA. Just call it FHA. Nobody calls it by its other name. But this, you guys, is a part of the U.S. Department of Housing and Urban Development. Okay, you guys? Now, I love the FHA because they require you to put less money down. We're going to talk about the requirements, and then also talk about the credit score requirements, because it's much lower than what I told you guys about the Fannie Mac. Fannie Mac, for conventional, they need you to have a 620 credit score, and your credit score can be much lower with FHA, all the way down to a 500 credit score. But it's certain things we need to learn about when you think of 500 credit score to get a mortgage, okay? So with the FHA, they insure mortgages to encourage people to make loans on these home mortgages. Now, when I say they insure it, you guys have a special insurance on your mortgage. Now, the thing is, you guys will have to pay PMI, and this is going to be your mortgage insurance, basically. That's why I always tell people, if you can put 20% down and you can avoid this. I've seen buyers pay an extra $150 per month. And that's a lot of money because they have to pay it for the lifetime of their loan. And with FHA, you cannot take that PMI out when you hit that 20%. You cannot do that. So I tell people to keep that in mind. If you can't put more money down, put more money down, because that's money that you're saving every month. I wish I did the calculations on there, but I know it's a lot of money. So you're going to have that special mortgage insurance, and it's basically, if you default on it, they're going to come in and pay the rest of it off. So it's kind of like them having insurance. It's like it's insurance. So it's kind of like them having insurance. It is insurance. Okay. Now they have a different criteria than Fannie Mac, depending on your credit score. That's what they're going to determine on what you have to put down. So if you guys have a credit score below a 580, which means, your credit's not the best, they can still give you a mortgage, but they require you to put 10% down. So if you buy a $200,000 home, you have to put $20,000 down on it. Okay. So keep that in mind. Also, if your credit score is higher than a 580, then you only have to put 3.5% down, which is really good. So with that same $200,000 home, you only have to put $7,000 down. So that is really good for those people that want to put less money down. Again, if you could put more money down, you guys, you can avoid that PMI. That 150 can pay a bill, like a whole bill, you guys. Keep that in mind. And I'm not playing about that. I just don't want to have it. I teach you guys about these different things. You need to know the basics, and then you need to figure out how to avoid these different things and how to pivot around it. Now, if you guys have a credit score under 500, you can't get a loan. FHA, they go all the way down to a 500 credit score, but a lot of lenders would not even give you a loan because lenders could have even more requirements for you. But this is what the FHA loan, you guys. Remember, you can get a house with a 580 credit score and put 3.5% down. Okay. If you guys have a credit score under a 580, a lot of lenders, they really wouldn't want to do it. But some lenders probably could do, but you have to put 10% down. The higher your credit score, the better your interest rate. Remember, your credit score is going to dictate your interest rate. You want to have a very good interest rate. 1% or even a fraction of that percentage can change your mortgage by a lot of money, you guys. I'm going to teach you guys about that because it blew my mind when I learned how to calculate a mortgage on hand, like by hand with a calculator. I'm like, what? And then you just change the percentage by 1. So I want to teach you guys those different things, but let's go ahead and talk about the Experian Automotive in episode 22. I'll see you guys there.